Jeff, Zach, thanks for joining me.
Hey
Hey,
again,
Steve.
Steve.
Hey, we are talking about mortgage rates and what it's doing for residential housing or real estate in general. We're certainly impacted by financing rates. We've seen it move a little beneficially on some of our projects. The average rate on 30-year mortgages that fell slightly to 6.4% at the very end of August. That was reported. That's only a slight decline from a week earlier, but it is the lowest level since May 2023. Um, so we are seeing some beneficial moves in terms of rates, although it kind of is not any sort of huge big move. The 1.3% increase lifted sales in residential housing to a seasonally adjusted annual rate of 3.95 million units. So we are seeing some benefits there. Um, and there's some expectation that we might see some more cuts. And if we do, that really could be a positive for the real estate sector, but particularly the residential real estate. Some of your thoughts on just where rates are, where they're going, and potential impacts we could see here on residential or other real estate.
Sure. Throughout all of our video series, we talk about lower interest rates, higher prices. And we've had a double whammy of high interest rates and lack of supply. So it's really impacted the housing market. And that lack of supply has also buoyed prices, even though interest rates went up. So we never really saw the correction, or I mean, we didn't see the nationwide correction. We did see price adjustments in certain pockets, in certain areas for sure. Um, However, with interest rates and these cuts coming over the next 6 to 12 months, I anticipate another kind of housing boom that's coming around the corner as affordability kind of increases. We've seen wages go up, we've seen people stay employed, we've seen a robust economy, and now we're going to have favorable interest rates that are coming down where people can start to afford houses again. I think that this is going to be a windfall in the residential real estate sector.
I I don't know what to add to that.
Supply. Supply is improving.
Yeah.
Yeah, I might have a bit more muted expectations, but I do think this is going to be a good thing. It's going to help, and I think one thing that's going to help is I don't think we need to see necessarily huge interest rate drops because I think expectations have been reset.
Yeah.
I think it's at this point there's been so little interest rate relief, people have readjusted to a higher rate market, and we're going to get more activity now that people kind of psychologically reset with smaller reductions than we would have needed before. And this is definitely a part of the economy that was really been lagging. I think this is where we could see more support for the broad-based economy is out of real estate, specifically residential real estate. But I am a little bit muted here because we've talked about it before. The golden handcuffs problem is real. It's real that people have just locked in such low rates that you're going to need a lot more for some of those owners to sell. But what I think this is going to do is I think we don't need too much to get that marginal seller into the
Right.
market. So
It,
I do think we're gonna see that. Yeah, I agree. It's gonna be most likely it's gonna be a positive. Most likely it's gonna be a positive both for real estate and for the broad economy. But I do think we've got a little bit of a kind of new normal here just because of how many homeowners locked in super low rates that we're not going to get back to, and a lot of those folks are just not going to be selling. And I think one area we've identified as a good investment area is some of that more workforce housing because
right.
developers, with the cost of labor, the cost of materials, they don't want to build anything that they can't maximize the square foot on. So I think we're going to see some permanent supply constraints on kind of the more the workforce stuff. And I think that's going to remain for a while a good investment opportunity with existing product on the market, including in multifamily and whatnot. So yeah, generally agree, but I think there's some nuances to this also.
The only comment I'd probably make to that is I think some people don't think about the psychology of it as well. Generally somebody, the people who have houses stay in their houses for, I forget what the exact number is, but it's like 5 to 7 years. So those golden handcuffs may actually become, irrelevant to some degree. If you're selling your house for a premium over and above what you had and you're buying and moving into something smaller, especially for somebody, heading towards retirement, moving south, probably don't really care. Because that rate isn't much higher, that payment isn't much different. You may not have a payment anyway, because you're buying a house for cash.
Yeah, we've talked about it too, that we've seen a surge in all cash purchases and
Yeah.
transactions. I would argue that also still does kind of go towards a little bit more the wealthier end. And that kind of more workforce housing is going to remain, and it's an area we've targeted. So it actually will work out pretty well for us in our investment strategy if it kind of goes that way. Appreciate the insights, guys. Hey, if you enjoyed this video, give us a thumbs up. Click subscribe if you haven't already, and visit our website, selectfincap.com, and register for our newsletter and get a look at exclusive real estate investment opportunities in the commercial space. Thanks a lot.
Thanks, guys.